Hey option traders, today we're talking about what is a bear call spread. So a bear call spread is an excellent strategy for beginners and it's used when investors expect the underlying stock to fall. Remember, with options there are two types of options, calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A bear call spread is a credit spread, which means that you'll collect a premium up front for initiating the trade. For this trade, we're both buying a call with a given strike price and selling a call with a lower strike price simultaneously. Together, they create the spread. Both calls are on the same stock and have the same expiration date, but the difference in strike prices creates a range. The investor can expect a profit or a loss based on where the stock finishes compared with that range upon the expiration date. For the bear call spread, we expect the stock to go down between now and the option's expiration. But you can still profit even if the underlying doesn't move because the bear call spread benefits from the passage of time. Since calls lose value as the underlying stock falls, both options would expire worthless if the underlying price finishes below the lower call's strike. Here, the maximum profit would be the total premium you initially received. On the flip side, if the underlying moves higher, the maximum loss occurs if it finishes above the higher strike price at expiration. The short call has an unlimited loss potential on gains in the underlying, but the long call will start gaining value to offset the losses of the short call. That's what makes the bear call spread a risk-defined trade. It's important to know your potential gain, potential loss, and break-even points for the trade. This will depend on the width between the two strike prices of the calls in the spread. For example, buying a 70 call and selling a 65 call creates a spread that's $5 wide. If the bear call spread collects $1 of credit, the maximum gain is then $1 times 100 shares of stock that each option represents. So the maximum gain would be $100 per contract if the stock price is below the short call at expiration. The maximum loss would be $400 if the stock price is above the long call at expiration. Take the spread width minus the premium received and you have your max loss. The break-even point would be the short call strike plus the premium received. For more on other strategies, be sure to check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. And as always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases.